Hi everyone, it's David from Aventine here for another edition of our quarterly review. In this presentation, we are going to cover market performance, the state of the consumer, inflation, employment, and finish by outlining some areas of the market where we see opportunity. We named this presentation the fallacy of the Fed. This relates to the out-of-touch nature of how central banks report inflation versus the real cost of living increases people are facing in their day-to-day lives. Here we can see the year-to-date performance of different markets up until the end of the second quarter. What should be most striking is the dramatic outperformance of the tech-related sectors as well as consumer discretionary versus the rest of the S&P. Also, it appears that certain emerging markets are beginning to come alive, with Taiwan, Korea, Mexico, and Brazil all posting solid positive gains. Although the S&P 500 was up nearly 20% year-to-date through the second quarter, much of this was due to 7 stocks, known as the Magnificent Seven. The graph here shows the dramatic difference between the performance of Apple, Microsoft, Google, Amazon, Tesla, Meta, and Nvidia versus the market. Since the end of the second quarter, however, breadth in the market has picked up meaningfully. This matters because it bodes well for growth that an increasing number of stocks, including the small caps and cyclical companies closely tied to the immediate ups and downs of the economy, are showing signs of life. What is rather shocking is that the S&P 500 has erased all losses from the point when the Federal Reserve first started raising interest rates in March of 2022. Since that time, rates have increased from 0 to 5.5%, and the market has shrugged it off. As a result, we have seen a significant recent divergence between the S&P 500 earnings yield and the risk-free rate as measured by the US 10-year yield. Government bonds are once again significantly more attractive than equities from a yield perspective. As we know, investor sentiment often follows price action. As the market has recovered, investor sentiment has reached the most bullish level since 2021. It appears the consensus among retail investors is that the US will avoid a recession. The view is very different among institutional investors who remain defensively positioned. The concern doesn't just surround the state of the market, but government finances as well. The US federal budget deficit as a percentage of GDP is essentially at levels that can normally cause recessions. In fact, the US has had an extremely extended period of no balanced budget. The issue is that the response to any problem or recession has gotten more and more extreme. In 2001, we saw a large increase in additional deficit spending to stimulate the economy. The response was almost the same magnitude in 2007, and then the response to COVID broke all records. The follow-on issue is how much interest is being paid on the Treasury debt. Tax receipts are being completely absorbed by interest payments. In fact, the interest on Treasury debt now far exceeds all annual defense spending. The only solution is to raise taxes or to adjust or restructure entitlement programs, which would impact the lower and middle class significantly. Alternatively, the Fed could lower interest rates. Another result of all this stimulus, especially payments going direct to consumers, was that accumulated excess savings increased dramatically, represented by the blue shaded area in the chart. However, the latest readings have been coming down fast and are expected to turn negative as early as October. It is excess savings which has been holding up services demand. As the savings rate declines, consumer usage of revolving credit increases to fill the gap. We can see that credit card usage is increasing sharply as the prices of food and shelter have gone up significantly. This has a large and sustainable impact, as any carried balances are charged interest at a higher rate as well. The real fallacy of the Fed revolves around their inability to understand the consumer, and as a result, they seem completely out of touch with reality. The Federal Reserve printed 40% more M2 and put it into the system in 18 months, and as a result, you generated about 40% more inflation. For example, the cost of rent moved 18% in 2021 and 19% in 2022, and wages haven't come anywhere near that type of growth. Rent, car payments, insurance, and food have increased the cost of living substantially. However, this is underreported in CPI. As a result, weekly retail sales data looks very weak. Part of this is due to the extreme level demand for services such as dining and travel, but as time goes on, we continue to expect both retail and services demand to decrease. All of this has an impact on lending standards, which has a significant negative correlation to GDP and therefore recessions about 1 year forward. Here we can see that lending standards are tightening sharply, partly due to the yield curve and partly due to deteriorating consumer finances. Lending standards are also tightening for businesses as well. Still, what matters most to the economy is employment. While the unemployment rate is still well below its historical averages, it has begun to tick up slightly lately. We believe a recession is not imminent, as recessions happen when the unemployment rate meaningfully crosses its moving averages. What is interesting is how the unemployment rate has developed across different income classes. According to Bank of America, unemployment appears to have risen faster in the higher income group, and the magnitude of the change is impressive at approximately 40%. We believe that this is a result not only of hiring decisions, but also the increasing prevalence of automation and technological changes. These changes are impacting wages as well. The higher income cohort is seeing more negative wage growth compared to the lower cohorts. This could be a troubling sign for consumer spending, considering what we are seeing in credit card usage and continued inflation in rent and food. In a previous slide, we discussed the dramatic increase in M2 orchestrated by the Fed in 2021 and 2022, and now that is reversing. M2 includes the liquid portions of the money supply because it represents cash and cash equivalents. We see here that the year-on-year change has deteriorated dramatically and is at its lowest level since the Depression, significantly reducing liquidity in the system. However, one impact of this is that it takes the pressure off of inflation, as M2 and CPI have a high positive correlation. This chart is proof of that. Now, as we look ahead, we can see inflation, as measured by CPI, is coming down almost as fast as it went up. However, the more recent CPI readings are subject to large base effects. Essentially, the extremely high readings last year made it more likely to show declining inflation. As this older data starts to roll off, negative inflation surprises will be harder to come by. The chart to the right shows what the futures curve is pricing in for Federal Reserve action. In other words, this is the market's prediction for interest rates. We can see that the market is pricing in interest rate cuts from December of this year through the remainder of 2024. Now, at Aventine, do we think that the direction of inflation is to the downside? Yes, we do. However, it may not be as fast as the market is currently pricing in. So what happens if rates remain higher for longer? In that case, we would expect to see more and more credit stress. This is a good visualization from Moody's depicting the squeeze that's implied based on the Fed holding rates at current levels. As we can see, interest coverage, as measured by EBITDA divided by interest and capex, falls below 1 by the end of this year for a significant number of companies. A coverage ratio of under 1 times is unsustainable over the long term. And yet, corporate bonds now yield only 0.12% above the Fed funds rate. This is the lowest level since 2007, preceding the global financial crisis. Investors should typically welcome declining credit spreads when they're retreating from extremes. However, they should not welcome credit spreads that leave zero margin for error, as they do today. So what are we doing at Aventine in order to capitalize on market complacency? Well, in the current environment, the cost of portfolio protection using put options has fallen to the lowest level on record. In this market environment, it makes sense to get more invested and utilize options to protect against the downside. By buying puts, you can only lose the premium paid, while shorting the market can be costly over time. Another area where we see potential is in the commodity space. While much has been said about the transition away from traditional energy sources, oil demand continues to grow, being fueled by growth in emerging markets. Oil demand continues to reach new highs, while we have restricting supply from OPEC and a lack of growth in supply due to previous underinvestment. Finally, we think certain emerging markets look interesting given the differing macroeconomic dynamics. For instance, Brazil looks particularly compelling. Inflation is already at 3.4%, well below expectations due to the nature of the domestic economy. Meanwhile, the benchmark Selic rate is 13.75%. Brazil recently announced its first interest rate cut, and I expect more to come, which would fuel a rally in the domestic market. So, in conclusion, despite all the uncertainty and the Federal Reserve raising rates to its highest rate since 2007, the S&P 500 is off to its best start to a year since 1997, and the NASDAQ has recorded its best first 7 months since 1975. While much of this performance has been driven by 7 stocks, the market has erased all losses from when the hiking cycle first began. The consumer, however, appears to be deteriorating, as evidenced by shrinking excess savings and increasing use of revolving credit. Lending standards are also tightening quickly for both individuals and corporations, which has a high negative correlation to GDP. There are also some cracks beginning to develop beneath the surface in employment, although from a very low base. We believe that CPI is trending lower, however not as quickly as the market predicts. This could lead to higher rates for longer. As a result, credit quality could deteriorate rapidly as companies are forced to refinance at higher rates. As a result, we are looking at cheap ways to hedge portfolios, especially using put options, while maintaining our exposure. In addition, we are looking to markets with different macroeconomic factors, such as Brazil and commodities. I want to thank you for taking the time to listen to this presentation, and please don't hesitate to reach out to any one of us if you have any questions or to discuss your account further. Thank you.